If you're watching this video right now, that probably means one of two things. Number one, you're new to the stock market and have heard people online talking about shorting a stock or going short. Maybe one of your positions just got attacked by a short seller and you're not sure what all of this means or what to do with it, but you'd like to make sense of it all. Number two, maybe you know what the terms that I just brought up are referring to, and you're interested in learning more about short selling and how to do it, where to do it, or even what platform to use. No worries, because in this video, I'm going to be running through the basics, and then we'll be moving right along to answer all of those questions for you and much more, with our end goal being to quickly and effectively prepare you for video number 2 of this series, where you're going to start learning about shorting stocks and looking into short selling strategies. And we're going to be starting right now. Hey, what's going on? It's Pat from Top Ticker Trades. If this is your first time here and you want to learn how to grow your wealth through investing and trading stocks in the market, make sure you start right now by subscribing and tapping that bell so you never miss a thing. I'll see you in the video. Let's go. What is going on, ladies and gentlemen? Welcome back to the channel. Welcome back to another educational and informative video. I'm so glad and excited to have you guys here. You're watching video number 1 in our short selling series, where everything that has to do with shorting stocks, short selling, short squeeze, who wears short shorts, is all explained to you today. Well, maybe not today, but the basics will be explained today. This is video number 1 in the series, and then you'll be prepared and ready to go to the next video. So without any further ado, let's get started. So one way to make money on stocks that are coming down in share price, or maybe that you're expecting to have a drop in share price, is by short selling. Short selling can be used as both an investment strategy as well as a trading strategy, and speculates on the decline in a stock's or other securities price. While traders use short selling as speculation, investors and portfolio managers tend to use them in a more responsible manner. Okay, so they use them to protect their positions. For example, they'll use it as a hedge against the risk of downside on one of their longer positions. And this can be done in the same security or even a related one. So essentially, hedging is placing an offsetting position to reduce your exposure to risk. Now, to give you a very generalized and broad understanding of the term, a short seller is someone that does the opposite of whatever most of you are probably doing in order to make a profit, which would be buying. Most people only see things one way, and that's to buy a stock with the intent of making a profit if the stock goes up. But a short seller will typically wait until a stock is overextended and then they sell it. And this can be extremely profitable. Shorting is more widely used by professional traders with a lot of experience. And although it is a great way to make a lot of money fast, it also comes with a lot more risk than simply buying shares of stock. So you see, it ultimately comes down to not having a defined risk. So for example, if I buy a stock at $10 and then it drops to $5, ultimately I'm only down $5. And technically, I don't even lose that $5 unless I sell that share at a loss, at which point I'm then realizing a $5 loss. So what do I mean by realizing a $5 loss? Well, that reminds me, we have 2 new vocabulary words to add to your list. So number 1, a realized loss or realized gain. And number two, we're going to be talking about unrealized loss or unrealized gain. So obviously a realized loss or gain is one that you have already taken or recognized. In other words, whether you are up or down on your current position, you close it and then there it is. Essentially, there's nothing else that can affect the price of that position once it is closed. So either you were down on your position at the time and realized a loss, or you were up and you realized a gain. Now, unrealized, as the word implies, refers to an open position. So if I'm holding a stock that I bought for $1 and it shoots up to $10, but I haven't sold, well, hey, I've got an unrealized gain of $9, right? I'm not very good at math, but that seems like 9. So keyword here is holding. So it's unrealized because I technically haven't secured the gains, and it could go higher, but I could also take a loss, which would be very bad because $9 is a lot of money. Now, the concept is quite simple. Actually, what you're going to be doing is the 4-step process, okay? Step number 1 is you borrow the stock. Step number 2, you sell the stock. And then step number 3, you buy the stock back. Now, hopefully, you're going to purchase this stock back at a lower price than you sold it for. Otherwise, we've got problems and you're not looking at profit. You're actually going to be looking at a loss. So remember that. Rule number 3 should be your rule number 1. Buy back for less than you sold it for. Now, that's assuming that you have the opportunity to do so. You may not be so lucky. All right. And that's part of the risk, and we'll discuss that in a little bit. But let's go on to step number 4. Step number 4, you would reimburse your broker or the lender for the shares that you borrowed. Generally, when someone shorts a stock, they're doing so by using margin. And margin is kind of like a loan you're getting from your broker, and interest is going to be paid on that. So whenever you are shorting a stock and selling those shares, you're not the actual owner of those shares, okay? Your broker is. You're just some dude that borrows them, all right? And you can't forget about that because it's your obligation to pay that broker back. And not only that, you have to pay that broker back by a certain set time, okay? And what happens if you don't pay that broker back the amount of shares that you've borrowed is that the broker shows up at your house and breaks your nose, followed by the remaining however many bones humans have in their bodies. So, for example, if you're using Robinhood, they'll, send Robinhood over there to rough you up. And if you're using Webull, they send Webull over there to rough you up. So you definitely want to make sure that, everything is reimbursed on time, or there's serious consequences. Maybe I made some of that up, but anyhow, there's definitely risk involved. So let's take it back to defined risk. When I mentioned earlier that if I buy shares, okay, my risk is defined. If I buy a stock for, let's say, $10, the most I can lose is that $10. If the stock goes to 0, then okay, I lost the $10 because the stock is at 0. So by definition, that's what you would call a defined risk. But an undefined risk, okay, presents itself when shorting stocks simply because in theory, a stock can go up to infinity. All right. Now, will that ever happen? I don't know. I've never seen a stock go up to infinity yet. But of course, Tesla could be on its way, so could Apple. I don't know. Maybe Workhorse. We'll have to see. But let's talk about that real quick. It's not, even though it's not very likely or, probable, the rules of the stock market dictate that you must respect the fact that a stock can just keep going up. Now, quick example, let's say I have a short position open on a stock that I went short on and sold it for 10 bucks. Well, rather than it going down like I thought it was going to, let's say that it hits, 20 bucks, then 30, 40, 50 out of nowhere, okay? Now, that's what we mean by an undefined risk. You don't know where the heck it's going to go. And, technically, like I said before, it can just keep going up. So that's why we have to be careful with this strategy, and it can, come with some substantial risk. And one of those things that can make, shorting stocks extremely risky is called a short squeeze, which occurs when a stock or an asset jumps sharply higher and forces all of those traders who bet against it to close their positions, meaning they're going to have to buy these shares of stock in order to cover and avoid bigger losses. Now, you'll often hear the term shorts scrambling to cover, which refers to panic buying of shares by these same shorts that are needing to reimburse their broker, which in turn will cause the share price to go up even higher. So, which platform allows you to short shares? Well, pretty much any platform will allow you to do so as long as you meet the margin requirements to be able to do that. Now, some platforms offer you more margin than others. So what you'll want to do is call around and see what you can work out. But I know that, Webull will do it if you call them, your TD Ameritrade, Fidelity. It really just depends on you and what your needs are. And you guys can also check out the links in the description below. I've got a bunch of platforms listed there. So check those out if you want to. I do want to say one thing though before you go and try to short stocks. Unless you've been, in the market for a while and know exactly what you're doing, I do not recommend doing it. It's not something that, you want to come in as a beginner and just, jump right into. It is extremely risky and you're going to lose a lot of money. Congratulations, ladies and gentlemen, you've made it to the end of the video. If you found this video helpful, I ask that you help this channel out by smashing that like button, as it motivates me to keep making videos just like this one every single day. If you're not a subscriber, you should consider subscribing, as I publish valuable content like this daily. You can do so from your screen right now, and if you want to check out more of my videos, you can click on the video that you'd like to see on your screen right now. Thanks for watching, and I will see you guys in the next video.